Good afternoon, distinguished ladies and gentlemen. Let me welcome all of you to the 145th communique presentation of the Monetary Policy Committee, meeting that was held between yesterday and today. The Monetary Policy Committee met on the 21st and the 22nd of November 2022, confronted with the continued weakening of the global economy, due primarily to the persistent increase in energy prices, supply chain bottlenecks, rising inflation, looming food crisis, and sharp increase in interest rates, leading to tightening external financial conditions. The volatility of the oil market, driven by policy shifts by the OPEC Plus and the US government, is also creating considerable uncertainty in the market, thus making the overall direction relatively unclear. Moreover, global trade has dwindled significantly in 2022, with the outlook for 2023 looking rather weak. Global private and public debt portfolios remain high and in some cases expanding as several countries around the globe acquire debt to stay afloat. The committee appraised these and other developments in the global and domestic economies, as well as the outlook for the rest of the year and into the first quarter of 2023. 11 members of the committee attended this meeting. Global development. Global output growth remained weighed down by familiar headwinds arising from the war in Ukraine, China's zero-COVID policy, and the ongoing normalization of monetary policy in the advanced economies. These have collectively resulted in an energy price shock, historically high levels of price developments across several economies, and dwindling investment in capital markets of emerging market economies. With the war in Ukraine showing no signs of abating in the near term, the disruptions to energy and commodity markets associated with it are more than likely to persist well into 2023. While the pandemic has mostly dissipated in most parts of the world, China's zero-COVID policy is keeping its impact very significant as the frequent lockdowns in major industrial cities continue to derail the smooth functioning of the global supply chain. Consequently, the resulting macroeconomic uncertainties and associated shock spillovers remain heightened, thus increasing the risk of a global recession, which would severely retard the recovery of several fragile economies, especially within the emerging market and developing economies, still confronted with the lag impact of the 2020 recession. The ongoing capital flow reversals from perceived higher risk emerging market securities to the US dollar denominated securities with improved yields is also further hindering orderly global recovery to pre-COVID-19 pandemic levels. The International Monetary Fund, the IMF, have downgraded for 2022 and 2023 several times, retained global output growth at 3.2% for 2022, but further downgraded the 2023 forecast to 2.7% compared to 2.9% in its July 2022 forecast. Inflation across several advanced economies is expected to remain elevated in 2022, despite progressive rate hikes by several central banks in these economies. This is predicated on sustained high energy prices associated with the Ukraine war and continued disruptions to the global supply chain. In the emerging market and developing economies, inflation is expected to remain high for other reasons, including the persistence of exchange rate pressures, dwindling capital inflows, and a host of legacy structural issues. In the global financial market, Activities in several equity markets have gradually declined as investors take advantage of improved fixed income yields in the advanced economies with the progressive hike of policy rates. Global financial conditions are thus expected to continue to tighten in the near term as risk-averse investors reassign their portfolios. In general, therefore, the global economy and financial markets are confronted with significant risks in the short to medium term as the huge buildup of both private and public debt and the rising risk of debt default associated with the current trend of rising interest rates, disruptions to the energy market, and poorly functioning supply chains may tip several fragile economies into a new era of recession. Domestic economy. The data from National Bureau of Statistics (NBS) on real gross domestic product (GDP) showed that it grew by 3.54% year-on-year during the second quarter of 2022 and 5.01% in the corresponding period of 2021. The economy has thus sustained positive output growth for 7 consecutive quarters following the exit from recession in 2020. The consistent positive performance recorded was driven largely by the positive growth in the non-oil sector, particularly in the services and agricultural subsectors, complemented by continued policy support by the bank. CBN staff projections showed that the economy is expected to remain on a path of sustained positive growth, given the expected strong performance during the fourth quarter of 2022 and steady rebound in economic activities. Members noted with concern the persisting uptick in inflation for the 9th consecutive month, with headline inflation year-on-year rising to 21.09% in October 2022 from 20.77% in September 2022, an increase of 0.32 percentage points. On month-on-month basis, however, headline inflation decelerated to 1.24% in October 2022 from 1.36% in the preceding month, an indication that price development is responding to the bank's recent policy rate hikes. The persistent uptrend in energy prices and the prolonged period of scarcity of PMS petroleum motor spirit contributed to a sharp rise in transportation, logistics, and manufacturing costs, which fed through to consumer prices. Other contributory legacy factors include the lingering insecurity across the country, perennial flooding in major food-producing states, critical deficit of infrastructure in the country, and poor road networks, amongst others. The committee noted that broad money supply M3 grew further by 13.8% in October 2022 year to date, compared with 11% in September 2022. This growth was driven by increased claims on other sectors, in bracket financial corporations, public non-financial corporations, and private sector. In the financial markets, money market rates oscillated below and within the asymmetric corridor of the discount window facilities, in tandem with fluctuating liquidity conditions in the banking system. Consequently, the monthly weighted average open buyback rate increased to 15.91% in October 2022 from 11.49% in September 2022. The capital adequacy ratio (CAR) of the banking system declined in October 2022 to 13.4%, but remained within the prudential limits of 10 and 15%. The liquidity ratio at 40.1% was above its prudential limit of 30%. The non-performing loans ratio declined to 4.8% in October 2022 from 4.9% in the previous month, staying below its prudential benchmark of 5%. Monetary policy thus called on the bank to continue to maintain its tight surveillance over the banking system to ensure that non-performing loans ratio remains below the prudential benchmark. MPC noted with concern the continuing bearish performance of the equities market in the review period. The all-share index and market capitalization decreased to 43,839.08 and 23.88 trillion naira in October 31, 2022, from 49,836.51 and 26.88 trillion naira respectively on August 31, 2022. This decrease reflected the sustained sell-off and profit taken by investors rebalancing their portfolios to benefit from higher yields in the fixed income market sector. Other contributory factors include inflationary and exchange rate pressures, tightening external financial conditions, and rising sovereign risk associated with the forthcoming general elections. The committee observed the decline in the external reserves position as gross external reserves decreased by 1.34% at the end of October 2022 to $36.89 billion from $37.39 billion at the end of September 2022. With indications of lower crude oil prices in the future markets, members urged the bank to sustain its current policies to boost non-oil exports in order to shore up the external reserves. Between September and October 2022, under the Anchor Borrowers Program, for instance, the bank disbursed 41 billion naira to several agricultural projects, bringing cumulative disbursements under the program to 1.07 trillion naira to over 44.6 million smallholder farmers cultivating 21 different commodities across the country. The bank also disbursed 0.3 billion naira to finance large-scale agricultural projects under the Commercial Agricultural Credit Scheme. Consequently, the total disbursement under the scheme for agro-production and agro-processing stands at 745.31 billion naira to 680 projects. In addition, the bank released a sum of 48.3 billion naira under the 1 trillion naira rail sector facility to 7 new rail sector projects in agriculture, manufacturing, and services. Cumulative disbursements under this facility currently stands at 2.15 trillion naira to 437 projects across the country, comprising projects in manufacturing, 240 of them, agriculture, 91, services, 93 projects, and mining sector, 13 projects. Furthermore, under the 100 for 100 policy on production and productivity, the bank disbursed the sum of 20.7 billion naira to 9 projects in healthcare, manufacturing, and services. The cumulative disbursements under the facility therefore amounted to 114 billion naira to 71 projects. Moreover, the bank disbursed 4 billion under the intervention facility for the National Gas Expansion Program to promote the adoption of compressed natural gas for transportation and liquefied petroleum gas for cooking. In support of the resilience of the healthcare sector, the bank also disbursed 5 billion naira to 4 healthcare projects under the Healthcare Sector Intervention Facility, bringing the cumulative disbursement to 135.56 billion naira to 135 projects in pharmaceutical, 33 of them, hospitals, 60 of them, and other services, 42. Under the micro, small, and medium enterprises (MSME) sector, the bank provided support for entrepreneurship development with the disbursement of 1.3 billion naira and 10 million naira under the Agri Small and Medium Enterprise Investment Scheme (ACSMIS) and micro, small, and medium enterprise development for MSCDF, respectively. Hence, the total disbursement under these interventions amounted to 150.2 billion naira and 96.08 billion naira, respectively. Under the Export Facilitation Initiative, the bank provided support for export-oriented projects to the tune of 5.34 billion naira. Therefore, the cumulative disbursement under this intervention stands at 44.58 billion. Our outlook. The overall medium-term outlook for both the global and domestic economies remain clouded by uncertainties associated with the Russia-Ukraine war, lingering COVID lingering COVID-19 pandemic and continued lockdown of major industrial cities in China. The persistent tightening of global financial conditions and slowing global trade are also significant pointers to a weakening global economy. On the domestic front, available data on key macroeconomic variables indicate continuing rebound in output growth for the rest of 2022, which may occur at a much slower pace than earlier anticipated in the light of the unfolding domestic and external shocks to the Nigerian economy. The domestic shocks originate from the persisting insecurity, inhibiting economic agents, rising cost of debt and debt servicing, deteriorating fiscal balances, increased spending as the 2023 general elections approach, and a continued uptrend in inflationary pressures. Accordingly, the Nigerian economy is forecast to grow in 2022 by 3.3% CBN estimate, 3.2% the IMF estimate, and 4.2% Federal Government of Nigeria estimate. The committee's consideration. At this meeting, the Monetary Policy Committee was concerned that the global inflationary pressures have continued to trend higher and financial markets were also facing challenges. It observed that this was indeed the trend in Nigeria, with inflation attaining 21.09% in October 2022. The committee, however, seized the opportunity to appraise the efficacy of its decisions at the last meetings and came up with the conclusion that the decisions were beginning to yield the desired results, given that the rate of increase in inflation was beginning to moderate in view of the month-on-month deceleration in prices presented by the NBS, Consumer Price Indices. Members noted that though the global economy was progressively weakening due to the various headwinds derailing the recovery, domestic output growth remained positive as a result of the continued support from fiscal and monetary policy. MPC therefore urged both authorities to continue to harmonize its various policies to achieve the desired objectives of stable price and steady growth. In reaching its decision of whether to loosen, hold, or tighten the stance of policy, the committee felt that given that all the causative factors such as Russia-Ukraine war, supply chain disruptions, slowdown in China, and rising inflation in advanced economies and other headwinds were still dominant, a loosening option was not desirable at this meeting. The committee also felt that with the rising inflation, loosening the stance of policy would lead to a more aggressive rise in inflation and erode that gain already achieved through tightening. As regards whether to hold, MPC was of the view that a hold stands at a period close to December festive season and expected heavy spending during the 2023 general election at the time of high inflation would greatly jeopardize the gains of previous policy rate hikes and plunge the economy deeper into the inflation trap. MPC therefore decided to continue to tighten, but at a somewhat moderated rate, noting that tightening the stance of policy would narrow the negative real effective interest rate margin and thus improve market sentiment and further restore investors' confidence. MPC also felt that recent developments in terms of observed month-on-month deceleration in the rate of increase in inflation suggest that the previous tightening moves were yielding the expected outcome. It therefore felt that sustaining the tightening would further consolidate the decline in inflation, albeit more significantly. The decision. MPC noted that inflation has continued an uptrend, even though at a decelerating rate, despite its last 3 consecutive sizable policy rate hikes. The committee's choices were on whether to further hike rates or pause for the impact of the last 3 rate hikes to continue to feed through. At this meeting, therefore, the options considered were primarily to hold or further tighten the policy rate. The options to loosen was not considered, as this would gravely undermine the gains of the last 3 policy rate hikes. Committee thus voted by a unanimous vote to raise the MPR. 9 members voted to raise the MPR by 100 basis points, and 2 members voted to raise the MPR by 50 basis points. In summary, MPC voted to 1. Raise the MPR to 16.5%, 2. Retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 32.5%, and 4. Retain the liquidity ratio at 30%. Thank you most sincerely for your attention.
Thank you, Governor. That was the communique number 145 of the 288th meeting of the Monetary Policy Committee of the Central Bank of Nigeria. So yesterday, the 21st, and today, the 22nd of November, 2022. We will take a couple of questions from the press, and of course, tomorrow there's going to be a kind of deep dive on the facts behind the numbers. And so, you tell us your name, the media house you represent, and then your question.
Thank you, sir. My name is James, a major with This Day Newspapers. Mr. Governor, like you mentioned, you said inflation continues to be a problem to the economy, not only here, but even globally. At 21.9% year on year in October, it is really concerning. So what is the way out, sir, of this conundrum? Then my second question, sir, is concerning this flooding, the recent flooding witnessed across the country. What is the impact, likely impact on prices? Thank you very much, sir.
Good afternoon, sir. My name is Leah Katumbabatunde from Nigerian Television Authority. I'm taking my first question from the hike in which some analysts, like the one we've listened to just before you came on, saying that it will not bring down inflation. They're doubting that, and you also, and they sort of feel that it will hurt growth. What will be your view on that? And also, since you announced the decision to redesign the Naira bank notes, you've received support from Mr. President. So, however, we are having people talk about the deadline that it might be extended beyond January 2023 to allow citizens, especially those in the diaspora, to make deposits of their old notes. Can you speak to that, as well as the volume of money that has been received so far? Thank you.
Thank you. My name is Sunday Michael Ogu. I write for Daily Trust newspaper. Mr. Governor, I'm staying with the last question by Leah. At your last special briefing, you hinted that you seem to have noticed counterfeiting with higher denomination, of, especially the 1,500 Naira notes. With the redesigned Naira, are you looking at reducing the volume of the high currency note and encouraging the use of the lower denominations? I would like to get an insight into your strategy. Thank you.
Good afternoon, Mr. Governor. I'm Nduka Chejin of the Nation newspaper. Still on the design of the Naira, the CBN recently issued a statement assuring that it will protect the interests of vulnerable Nigerians. Does the suspension of charges on deposits made on commercial banks apply to those through mobile money? Thank you.
Good afternoon, Mr. Governor. I'm Nancy Naji, the anchor of Moneyline with Nancy on Reality. My question is around, I recall that some time ago, you did actually say that the CBN intends to gradually stop the quasi-fiscal commitments made by the banks, made by central bank. Also in media reports, we've seen at least in the last few days that it's been reported that the Central Bank of Nigeria wants to stop the Anchor Borrowers program. So I want to know what the status is on the Anchor Borrowers program, as well as other related interventions, and also perhaps even the flooding, how it will impact your intervention, since a lot of farmlands were submerged on the flood. Thank you.
Okay, Governor, there are two questions from some journalists from Lagos. This is from Kolaido Leadership. Question, the CBN website has an exposure draft of the guidelines on contactless payments. Could you take us through that, sir? And then the final one from Babajide Komolafe of the Vanguard. Mr. Governor, congratulations that the National Theatre resuscitation has started yielding results, because we saw that an international conference was hosted 2 weeks ago. When will the entire project be ready? That's all for me.
Well, let me thank those who are asking questions and those who forwarded questions for us to address. It's always a good opportunity for us to explain certain things that are happening around the way we do our work, particularly in the monetary policy committee decisions. The first question said that inflation is a major headache to central banks around the world, and that for Nigeria, the inflation has hit an all-time high of 21.09%, and that what is the way out of this economic dilemma. You are very correct. To all central banks, inflation is indeed a very, very big headache, and even at this time, it's a big challenge to everybody. This is because everybody knows what impact inflationary pressures can have on the purchasing power of particularly the ordinary people. And these are the people that mainly we have been given the responsibility to make sure that a worsening, inflationary pressure does not totally push them further down into the poverty ladder. However, it is important for us to know that some of the causative factors why the inflationary pressures have persisted since the early part of this year, which include the Russian-Ukraine war, is not abating yet. The war is still going on very aggressively. US is still raising rates, which therefore will naturally not only lead to outflow of funds to the United States and advanced economies, but will even prevent flows from coming out. Not only that, not just that flows are not coming out, those flows are coming even at very high rates, even within the United States. As a result, financial market conditions globally have tightened, and this is also creating a very great challenge for central banks or policymakers, particularly those that may want to access debt to run their operations. And lastly, of course, the issue of the China market slowdown, the China slowdown is also a big issue for the global economy. So I would like to say that these same scenarios still remain in the Nigerian environment, and as a result, we would continue to see the inflationary pressure remaining persistent. However, we feel comforted that the rate of increase in prices, in which the rate of increase in inflation is moderating gradually in Nigeria. For instance, between June and July, the rate of month-on-month inflation was 1.82%. Between July and August, the rate of month-on-month inflation was 1.7%. Between the month of August and September, the month-on-month rate of inflation was 1.3%. And between September and October, the month-on-month rate of inflation was 1.2%. So for us, we feel that even though the time-tested monetary policy theory expects that at the time when there's inflationary pressures that we would continue to tighten, we'll continue to raise rates, but for us in Nigeria, we feel happy that the decisions that we took in May, in July, in September have started to yield results because the aggressive nature at which we see the inflationary pressures are abating and it is in fact declining, and we are hoping that all things being equal, because economists must talk about all things ceteris paribus, that this trend will be sustained and we begin to see that the inflation rate come down. So our way out remains that we will continue to see what can be done, but you could see that because we started to see that the rate of increase in prices is moderating gradually, month on month, we were aggressive in September in fact, raising CRR by 5% to that 2.5, and also raising NPR by 150 basis points. But at this meeting, we saw majority saying, let us moderate it and do the rate of increase by 100 basis points. Indeed, 2 members saying that they would have wanted, if they had a chance, they would have wanted the rate of increase in rates to be at 50 basis points. So I would say the monetary policy is looking at it, and I believe that in the course of time, we will see an improvement in the macroeconomic environment. The second question by James Major says that what, in my view, would be the impact of the recent flooding on prices in Nigeria? Like I said, I said ceteris paribus, all things being equal. But what you would expect, that with the flooding the flooding of this year happens to be the worst in the last 5 years in Nigeria. I think I read that out of 36 states, 33 states were impacted adversely by the flood. What that meant was that people who went to farming during the rainy season, they lost their crop. So what would you expect in that direction? You would see that prices of goods will go up, or agri products will go up. But from our side at CBN and the federal government, particularly for rice or for grains such as maize, we know that we have our own strategic reserves, which we will use to moderate prices as they get more aggressive. We've been doing a strategic reserve program for almost 3 years, and it is yielding results, and we believe that that will help to moderate. But more importantly, our development finance is holding meetings and discussions with stakeholders that we will normally work with for planting, our smallholder farmers and the rest of them. And since the flooding is beginning to recede, we would aggressively go into a dry season planting program that will make sure that the impact of the rising food prices does not linger for too long, so that we can have good control on the price of our agri products, which eventually will feed through into the prices of ultimately the goods that our people consume generally. So we're doing everything possible to keep it low, but it is not possible for us to commit that prices will not go up. It will, but we are doing everything possible to keep this at moderated level. The third question says analysts are still doubting whether the consistent rate hikes will bring down inflation. They also feel that raising rates will hurt growth. I will address that. We all know that raising rates will hurt growth, because if you are dealing with reining in inflation, which means tightening and raising rates, that will ultimately, the rising interest rates will hurt manufacturing and agricultural output, that will ultimately hurt the growth. We know that. But at this time, given the aggressive rate at which inflation is trending upwards, monetary policy, seeing inflation or combating inflation as its primary mandate, feel that we must deal with it. Not just that we must deal with it, but also because we believe that at 21.09%, inflation is already hurting growth. If we did not see this high level of inflation in the last 7 months, we would have been damn optimistic that growth would have hit close to 4%. But because of the aggressive rate of rise in inflation, it is hurting growth at this level in Nigeria. And that's the reason you would see that we are taking this very, very seriously. Because whether you even try to either loosen or hold rates low, what you will find is that at this kind of levels of above 14 to 15%, into 21%, growth would either decelerate or at best will be very, very weak, will not be at the level that you think growth rate should be. So that is the reason MPC remains pro reining in inflation, to make sure that we're able to keep prices at moderated level. The fourth question says that we have unveiled 200, 500, and 1,000 naira notes, and that we have received support from the President and the Senate, but that there are people who are saying that that the deadline is short, and that we should shift the deadline from January 31, 2023. And also talked about the fact that those in diaspora also need to deposit their old notes. Let me crack a joke. If you are a diaspora Nigerian, you are not supposed to be spending naira, right? You cannot spend naira in the US or in London, so you have no reason to keep naira. So we don't have business with you if you say that you want us to wait for you to bring your naira from US into Nigeria. We will not wait for you. That's a joke though, but it's a fact. But we thank Nigerians. We thank Mr. President, not just because he gave approval to the Central Bank of Nigeria to embark on this program in line with the dictates of the CBN Act, but we also thank Mr. President because at a time when we were beginning to face criticisms, without being prompted, he came out, or he has come out twice to defend the action of the Central Bank of Nigeria. We thank Mr. President for this and other support that Central Bank of Nigeria has received from him over the past 7.5 years. We are indeed very grateful. We want to thank the security agencies that have worked with us to see to a smooth transition of this program, particularly the EFCC, that has done a great work in collaborating with us in monitoring the flows. We are grateful. We thank the Senate, who, in spite of pressures, decided to also give us their support. this support means a lot to us. But the question that has been raised is that, are we going to shift the deadline? The answer remains no, capital no. We will not shift any deadline. What we have done is not against the law. It is in tandem with the law. We announced this program on October the 26th, 2022, and we said that upon release of the new currency, that the legal tender status will run concurrently with the old currency till 31st January 2023. That is almost 100 days. 100 days is enough for any person in any part of Nigeria to deposit his money in the bank and get ready to withdraw cash when the new notes are released. For information, indeed, we are no longer waiting till December 15th to unveil and begin to release the new notes. By the special grace of God, tomorrow, which is the 23rd of November, 2022, the President has graciously accepted to unveil the new currencies, and the new currencies will be unveiled tomorrow at the Federal Executive Chambers by 10 a.m. tomorrow morning. So you are invited to stay tuned and live. Now, so when you talk about whether we have made adequate provisions to make sure that those who have cash are able to deposit their cash in the bank, my answer is yes. Because on 26th of October, I made it very clear. I said all banks will keep their currency processing centers open from Mondays to Saturdays. We went further, released a press release, and said that Central Bank of Nigeria's 36 currency processing centers all over the country will also be left open from Monday to Saturday to receive cash. 3, we have deployed our agency banking network to receive and in fact pay cash when the new notes are released to those in our rural areas. So when people say there are people in rural areas who cannot pay cash, they just are begging the question. They don't know what they are saying. They have other motives, and it is not because they are sympathetic to the cause of the ordinary weak people in our rural areas. In 2020, the Central Bank of Nigeria, or Banking Industries Agency license network, was only 86,000. As at October 2022, our agency banking network has increased to 1.4 million all over Nigeria, in almost all the local governments in Nigeria. I therefore cannot see any reason why anybody would say that he needs an extension because he can't deposit his money in the bank, even if you are in rural areas. And the rural areas are the agency networks. It's like saying that we have 1.4 currency points all over the country. Then how can anybody come and say that he wants to shift the deadline because there are people in rural areas that cannot deposit cash? That is a lie. Big